Okay, welcome to investment problem number 1. This is the first crack, or our first attempt at the investment problem, and this is the first clip out of several clips for this one problem. This is the introductory clip, and in this clip we're just going to talk about the assumptions for the investment problem. And then in subsequent clips we'll do the investment problem, the calculations, and step by step. But again, this first clip just goes over the assumptions that go into the investment problem. Well, first of all, where do these assumptions come from? As you can see on the screen, we have basically 9 different assumptions about the property. And a good question is, and a common question is, where does this information come from? Well, the answer, it comes from the market. These assumptions come from the market. They come from market research and analysis of the market, knowing the market, talking to participants in a local market, and so on. Now, for purposes of this problem, I made this information up, but it comes from the market in the real world, okay? But I made up some assumptions to take you through the mechanics of the investment problem. And a good point here is that this is just a model. This investment problem, discounted cash flow analysis, it's a model. And if you put garbage into a model, what do you get out of a model? Yeah, you get garbage out. But if your assumptions are good, the model is very useful and very powerful way to analyze a real estate investment. Also, I want to emphasize that this basic model, we're doing a very simple property, a 2-unit apartment building, but this investment problem, discounted cash flow approach, is the same basic model that's used to analyze shopping malls, office buildings, industrial buildings, all types of property. It's the same basic nuts and bolts. It's just that to start out, we're using a pretty simple problem. It can get much more complicated very quickly, and it will. But to start out this problem, we are considering the purchase of a 2-unit apartment building, and we have $55,000 that we can use. And it's up to $55,000, but not over $55,000. We don't have to use all $55,000, but we have up to $55,000 to use. Each apartment is a 1-bedroom unit, and here are the 9 fundamental, research assumptions or information that we have to complete the problem. The first one, the asking or list price is $135,000. We're going to assume, for the purposes of this problem, that we can acquire the property at its asking or its list price. Now, I know, our goal as an investor is to buy low, okay, and maybe we can negotiate a lower price, which might be true. That would be nice. A lower price would increase our return. But for the sake of this problem, let's assume that we can acquire the property at the asking or the list price. So it's safe to assume that we can get this property for $135,000. The appraiser has allocated the market value at 15% to the land and 85% to the building. So what we're saying here is that of the $135,000, and I'm going to switch windows here briefly, 15% is land value, and 85% or $114,750 is building value. And why do we need to break this up? Why are we breaking this up into land and building? There's one particularly very good reason why we need to do this. Well, as part of the investment problem analysis, we need to calculate depreciation. And the government, the IRS, lets us depreciate real estate, but we depreciate the building or the improvements only. We don't depreciate land. Land is not said to depreciate, but buildings, improvements, they wear and tear over time, and they depreciate over time. And for investment analysis purposes, we can take a certain amount of depreciation each year, which is a desirable thing to do as an investor, because depreciation shelters a little bit of cash flow that the property generates, and that's a tax advantage. But we can't depreciate the land. We can only depreciate the building. So our depreciation basis is $114,750 in this problem. Going back to our narrative, okay, our next assumption is the market rent is $725 per unit per month and is expected to increase by 5% per year over the next 5 years. So we've done a market study. We've determined that the rent for these one-bedroom apartments in this market, it should be $725 per month per unit, and that's what we can expect to rent these units out at. We are going to do our cash flow statement, our investment problem, on an annual basis. So one of the things we need to make sure is we take 725 times 2, but also times 12 to annualize the what's going to be the potential gross income in our investment problem. Now, we expect to hold the property for the next 3 years. Okay, this is very important. This is our holding period assumption. And we're going to do our discounted cash flow analysis, our investment problem analysis over a 3-year holding period. So we're going to have year 1, we're going to have year 2, and year 2 income is going to increase by 5% over year 1 income. And that's based on our assumption that the market rent is going to increase by 5% per year. You know, it says over the next 5 years, but you know, the last 2 years, you know, that's fine. Our holding period is 3 years, so it's gonna increase by 5% for the next 3 years is our expectation. And then the third year income is going to be 5% more than the second year income. The third assumption or input, vacancy and collection loss in this market has been and is expected to remain at 4%. So we're going to take 4% of what's going to be called our potential gross income, and that's going to be what's called our vacancy and collection loss. It's an account to reflect that maybe over the course of the year, one or both of our units might be vacant for some portion of the year, and that's going to result in a loss of rental collection. Vacancy and collection loss. The collection loss part of vacancy and collection loss refers to that sometimes, even though the property is occupied, sometimes tenants don't pay their rent in full or on time. So that could be a collection loss component of vacancy and collection loss. So it's to account for vacant space in the property over the course of the year, and also the fact that, you know, occasionally we don't collect the rent in full or on time. The fourth input, operating expenses, are currently $2,400 per year for fixed expenses, $1,500 for variable expenses, and $700 per year for reserves. So our fixed expenses might be things like property tax, property insurance. These are two classic fixed expenses, and they're called fixed expenses because fixed expenses don't vary much with occupancy. The property could be vacant or it could be 100% occupied. We still got to pay our property tax, which is set at the beginning of the year, and we still got to pay our property insurance. $1,500 for variable expenses in the first year. Okay, variable expenses might be things like maintenance, repairs, utilities. If the investor pays, you know, part of the utilities on the property, and also management expense, the expense of hiring a manager. And then finally, the $700 per year for reserves. This is a replacement reserve or reserve for replacements. And this is basically a sinking fund account to periodically replace the short-lived components of the building. Every couple years, we got to replace the carpeting, maybe repaint interior or exterior. So what we're going to do here is we're going to create a reserve, and we're going to fund it with $700 per year for the first year. And this reserve account is going to be used to replace the short-lived components of the building, and the roof is a good example. Okay, maybe some of the HVAC equipment, new air conditioner, compressor, carpeting, and those types of items. Now, the operating expenses will increase by 5%, 6%, and 5% per year, respectively. So what this is saying is that, you know, for the first year, the fixed operating expenses will be $2,400, but the next year it's going to be 5% higher. And in the first year, the variable expenses are $1,500, but next year it's going to be 6% higher, and it's going to increase by 6% each of the subsequent years. And the same with reserves. Why do we have different increases? Okay, maybe variable expenses, for some reason, we expect to increase a little bit faster than fixed. and also our reserve account. Maybe variable expenses include utilities. We think utility prices are going to go up a little bit quicker. Assumption number or input number 5, the property is anticipated to appreciate in value by a total, okay, that's a lump sum total of 9% over the 3-year holding period. Now that's not 9% per year, but it's 9% lump sum, just total. In other words, we're going to sell the property for 9% more than what we paid for the property. And let's see if we've calculated that, or no, maybe we haven't. But let's see if we calculated that already. Okay, we didn't calculate that yet, but we will shortly. Okay, so that's the holding period assumption. Number 6, okay, input number 6. This has to do with the financing of the investment. So we're investors, we're going to buy this property, but we're going to use other people's money to buy the property primarily. Okay, we're going to finance, we're going to get a mortgage on this investment. And the lender is quoting a loan-to-value ratio of 80% for 30-year mortgage loans, and that's monthly payments with a 10% interest rate. Now, we're going to have to figure out how much of the loan is paid off every year, and there's a couple reasons we need to do this. One, to calculate our cash flow, we need to know this, and another reason is when we sell the property, we have to pay off the loan, and we need to know what the balance of the mortgage is at the end of the 3rd year when we sell the property. But what I've done here is I've given you the amortization, the amount of principal reduction on this loan, okay, each year, okay, for the first 3 years. And there's a couple ways you could do this. You could do this on your calculator. For this example, I used a spreadsheet. And here's our spreadsheet. This is our spreadsheet that's on the website, just a simple amortization table. And I put in the mortgage amount of $108,000. It's a 30-year mortgage with monthly payments. The interest rate is 10%. Okay, so our beginning balance is $108,000. Our debt service should be $947.78. That's per month. For the first month, the first payment, the interest is $900, and that means $47.78 is left over to pay down the mortgage balance. That's the principal reduction or the amortization. And you notice I had the principal reduction for each of the payments. And if you go down to the 12th payment, okay, the 12th payment, and you sum up all the principal reduction components of each mortgage payment, that should sum to $600 approximately. Okay, I did round a little bit here. Now, if you go to the next year, okay, the next year starts out with payment number 13 and ends with payment number 24. And if you sum up those principal reductions, okay, I had the interest column highlighted, but I want to make sure I highlight the principal or the amortization column. That should sum up to $663. Okay, and then so on for the 3rd year. If we sum up all the principal reduction components of each mortgage payment for the 3rd year, it should sum up to $733. Okay, so that's where that information came from. It came from basically an amortization table. Assumption or input number 7: brokerage commissions are and should remain at 6%. Okay, this is we're going to use this when we sell the property. At the end of the 3rd year, we're going to assume that we're going to need the help of a broker, and we'll pay that broker a 6% commission from the sale of the property. Okay, so that's 6% of the future sales price on the property. Input 8, this is the depreciation assumption. The property could be put in service in January. The IRS depreciation rates are based on straight line depreciation, and we're going to assume the depreciation period is 27.5 years, which I think is the actual depreciation schedule or recovery period for residential income producing property. Okay, we can't depreciate our single family home, but we can depreciate our residential investment properties, and I do believe it's 27.5 years. These depreciation periods change occasionally, and but I think for residential it's 27.5 years. And then finally, these are our personal assumptions about our investor, or about ourselves. Our effective tax rate is 28% for income and 28% for capital gains. Many years ago, there used to be one rate for both income and capital gains, but now we have a split rate, and generally the capital gains tax rate is lower than the income tax rate. But on any income the property generates, we have to pay 28% federal tax, and on any capital gain from the sale of the property, we have to pay a 20% capital gains tax. And you feel that you need a 15% rate of return on this investment to cover your perception of the risk. So our 15% here is what's called a hurdle rate, or required rate of return. To attract us to this investment, we need to earn a 15% rate of return on this investment. So this is our required rate of return, sometimes called the hurdle rate, because we need to jump over it or meet it to make this an attractive investment for us. As you're going to see, this is going to be the discount rate that we use to discount our cash flows that we're going to estimate in our discounted cash flow investment problem. But basically, these are the assumptions for our investment problem. What we're looking at here is the assumptions kind of in a narrative format. But what you could do, and what I do in the actual investment problem, is I lay the assumptions out on the spreadsheet, in a spreadsheet format. So basically, these are the same assumptions that we just went over, or they should be. If they're not, please let me know. But they're just organized differently and laid out without all the narrative. Okay, just labels and numbers. But here's our list, our asking price, $135,000, 15% land value, 85% building value. Here's our market rent of $725 per month per unit. We have 2 units. The rental rate's going to increase at 5% per year. The holding period, we're going to assume a 3-year holding period. Lots of discounted cash flow analysis. The holding period might be 5, 10. You know, I've even commonly see 15 and 20-year holding periods. But this is our assumption for this problem. I'm using a 3-year holding period to keep it simple. We're going to do this by hand. So a 20-year, you'd be a little bit annoyed with me if I had a 20-year holding period, okay? Especially if I made you do this by hand. But a 3-year holding period is you know, even easy to do with a calculator. The property appreciation over the holding period, 9% lump sum. The vacancy and credit loss, 4%. Our operating expenses for the first year, $2,400 fixed, $1,500 variable, $700 for the reserves. The operating expense increase per year, 5% for fixed, 6% for variable, 5% for reserves. Here's our financing assumptions. Okay, we've talked to lenders in the market, and this is what these are the terms they're willing to lend for this type of investment. They're willing to lend 80%. The term, 30 years, or 360 payments, based on 12 payments per year. The interest rate is 10% per year. And here again, we have the principal reduction on the mortgage that's given to us, but we know how to calculate these from an amortization table or using our calculator. Here's our brokerage commission. Okay, and by the way, the mortgage amount was $180,000, which was 80% of $135,000. Brokerage commissions, 6% we're going to assume. The IRS depreciation recovery period, 27.5 years. The investor's effective tax rate for income, 28%. Capital gains tax rate is 20%. And the investor's required rate of return, that hurdle rate of 15%. So there's all our investments, or assumptions. And the next step is we're going to calculate what's called before tax cash flow. And please go on to the next clip. Thank you.